All right, we're back for another episode of the Remo Show, the Real Estate and Mortgage Podcast. You might notice we dropped YVR. It's a new year. It's a new season, and we're looking to just get refreshed and have a bit of a revamped show here going forward. And we're really excited. It was a tough year to say the least. 2023. We've touched on this time in and time out. It was a tough year for real estate and financing industry in general across the country. And we're looking forward to getting into a number of topics, a number of a lot of what you're used to. And we're going to start off today with just the timing the market, when to lock in your variable rate and potentially refinance. We've touched on this countless times in the past. It's a good topic to come back to because things are constantly changing in the market, and ultimately that's why we're going to touch on this one first this year, because this question has been coming up quite a bit. So we'll start off just with a brief introduction to the host. I know we kind of just jump into these episodes and we just start chatting. So just with the first episode of the year, I'm Dean Lawton. For anyone that is maybe a new listener or forgot who I am, that's who I am. I'm one of the partners here at Thrive Mortgage and the Remo Show in general. We've been looking forward to jumping in here, and we'll pass it off to Tyler and go around the table for a brief introduction.
Yeah, I'm Tyler. Tyler Trumpeter. I'm with Thrive as well. I've been here for a year now, and one of the partners here, and excited to get into this episode.
Yeah, Derek Williamson. You guys have probably heard my voice many a times, and I'm looking forward to a year of hopefully much more positive episodes here, and not so much combat. So
unless F-bombs or what?
There's only a couple of us.
Yeah, we do have to censor Derek, so Paul's working on that behind the scenes. Paul with the camera and the master behind the scenes. So thank you for that. A quick summary of what we're going to talk on. So we are going to touch on, like, when does it make sense to lock in? There's a lot of people sitting in variable rates, waiting for the rates to come down. Obviously probably considered locking in a number of times over the last couple of years with rates going up. And honestly, there's still a lot of people considering this, and there's still a lot of people making the decision to convert to a fixed rate. So we're going to jump into all of that today, and when it would make sense to refinance. Just a quick recap on our previous episode. We had some great episodes around our predictions for this year. We recorded that actually just before the holidays, and it was released recently. But I think all those predictions are still intact. I wouldn't really change anything yet. So have a listen to that if you haven't listened to that already. And let's jump right into just understanding variable rate mortgages. So Derek, why don't you start off? Like, what is a variable rate mortgage?
Variable rate mortgage is essentially, it's a standard mortgage product, and comparing it to a fixed is a fixed term. So if you take a 5-year fixed, you have a specific rate, a specific payment for the full 5 years. Nobody can take that away from you unless you decide to refinance or break the mortgage early. Variable is kind of the opposite when it comes to the rate and the payment. It's all tied to Bank of Canada, so it's not tied to bonds, it's not tied to fixed interest rates, it's tied to the Bank of Canada and what they do with the overnight lending rate, which is all tied back to our economy, essentially, primarily inflation. So if Bank of Canada is raising rates and you have a variable rate mortgage or a home equity line of credit, which is a different discussion, if rates are going up via Bank of Canada, your rate is going up, and in most situations, your payment's also going up. Vice versa, if rates are coming down, your interest rate is going to go down accordingly. If Bank of Canada drops by 0.25, your rate drops by 0.25, and that'll adjust how much interest compared to principal you're paying. To go a little bit deeper on that, there are two types of variable mortgages. One's known as an adjustable rate mortgage, and that essentially is when the Bank of Canada raises rates, your rate goes up and your payment goes up automatically. There's nothing you can do to stop that. When rates go down via Bank of Canada, your rate and your payment go down. So on the downslope, it's a great thing. On when rates are going up, it can be a little bit challenging because your costs are increasing, your mortgage payments increasing, which we've seen drastically over the course of almost the last 2 years, I guess you could say. A true variable, so a VRM or a static payment variable is what it's referred to. If rates go up, your payment isn't actually increasing unless you choose to increase it. So that product essentially gives people the ability to be in a variable product, have all the benefits of the variable. It's a more flexible product than a fixed when it comes to penalties and a few other guidelines there. But if rates are going up and you're not increasing your payment, you're just going to start paying more interest and less of your principal, which extends your amortization. So that's a variable. times have changed a lot. I mean, I've been doing this for a little over 10 years, and for the first 8 years of it, variable was hands down the most chosen product by all of the clients that we've worked with. Since we've seen some pretty drastic upswing in interest rates from the Bank of Canada, it started to change a lot of people's minds on what they're doing. We've seen a lot more short-term fixed rate products. So I'll kind of cap it there and swing over to Tyler.
I guess the other piece of this episode we wanted to get into is whether or not you want to refinance or lock in your variable rate. And as Dean mentioned off the hop, obviously last year was a slow year for real estate in general. It was particularly slow in the mortgage world because the refinance business basically dried up, right? And why did it dry up? It just didn't make sense. Like for a lot of people, it didn't make any sense to refinance to get out of their much cheaper rate into a much higher rate. So, that in itself is a bit of a definition about refinancing. Like, what is refinancing? It's breaking the term of your contract to either add more money to the mortgage to consolidate debts or reamortize. There's a few different reasons why you would do it, but to understand what a refinance is, when you took your mortgage, you signed up for, some amount of term on your contract. Most commonly taken is a 5-year term. If at some point within that term, you need to access equity in your home, i.e. borrow more to either do a renovation, invest in RSPs, maybe buy a rental, maybe pay down consumer debt, you need to break the term of that contract to borrow more. And so you're either going back to your same bank or a different lender to either renegotiate or requalify to access that extra equity that you have. And for years, as Derek was kind of talking about, for a good 10, I would almost say 12-year period, as rates were really coming down, it really made a lot of sense for people to, okay, well, we've got this, $30,000 boat loan, $20,000 personal line of credit. This is all 8, 9, 10, 20%. Let's refinance, roll that into the mortgage and get everything consolidated into one nice payment. What we saw over the last year, specifically with interest rates, the highest they've been in 15, 20 years, that the math just didn't make sense, right? A lot of people just decided, let's just get through this. Let's get through this tough cycle and just wait for rates to cycle back down. So I think the genesis of this pod, the reason we wanted to focus on it is because now, as we touched on our last episode, it feels like the peak was in October and rates are cycling back down. So refinancing and locking in is going to start to make sense.
Yeah, that's a great point. Great, well said. Maybe just like, I know for a lot of our listeners, they're thinking like, well, does it make sense to lock in now? And so why don't we just touch on kind of where things are at from the current marketplace? Where we touched on this from a prediction perspective in our last episode on like where we see rates going this year. The bond market has continued to gone down. We had a little bit of a blip today on recording day, but it's come right back down. Just given some of the reports that are coming out of the U.S., which, it's important to understand that our market does follow the U.S. largely, regardless of, how challenging our economy is. And our economy is suffering right now. We are seeing things turn, which is good for mortgage rates, but not great for the economy. And again, when talking about these types of factors, it really is more so around the fixed rate market. And looking at the difference of where the variable rate is today versus the fixed rates today, that is pushing a lot of people to consider locking in. And we're going to touch on a case study of an actual real life scenario shortly here. But just before we do that, like, again, just, circling around with the market and where things are at, how would you advise a client right now?
Locking in, if you're wondering what the heck locking in is, that's applicable to you if you have a variable rate mortgage. So, depending on what bank that you're with, at any time that you carry a variable rate mortgage, you can convert it into a fixed rate. That's the technical term of locking in. The most important distinction, and I try and explain it to every variable rate client that I take, locking in doesn't mean, okay, I'm hitting freeze on my interest rate. It means you're going to convert it into whatever fixed rate the bank offers at that time.
What advice would you give a client?
Well, it's totally dependent on their personal scenario. It seems very enticing right now because you could almost guarantee, you could pretty much guarantee if you're going to be locking into a cheaper rate than what you have right now on your variable because of the last 2 years and where interest rates have gone. So immediately locking in will give you some interest payment relief depending on the product you're in. Derek talked about the static or fixed payment true variable rate mortgage, and then the adjustable rate mortgage. With the static payment, you locking in, it may or may not, have a drastic impact on your payment. In some cases, it might actually increase it. With an adjustable, if you do consider locking in, you will get some immediate payment relief. It's just, are you locking in at the top end of the cycle, or can you hold on a little bit longer? As I mentioned, earlier, the other thing to consider is how's the rest of your financial picture looking? Was it really difficult to get through these high rate years that we had over the last couple of years? Did you end up taking on more debt? If that's the situation, I mean, the simple math of converting, credit card, line of credit debt at 15 to 20% into, mortgage debt at around 5%, it starts to look pretty appealing.
Yeah, I think another major consideration if you were going to be converting is understanding like the lender that you're with, the product that you're in, and how much time you have left on your term. Because like if you have 4 years left with most lenders and you're going to go convert, they will typically convert you into a 4-year fixed. And as much as you might get some immediate payment and rate relief, like you're still converting into a fixed rate at inflated interest rates for a pretty long period of time, when everything that you read and everywhere you look, they're talking about rates coming down in the near future. Fixed rates have come down like probably more than 1% in the last month and a half, which is massive. And this is where timing is so important, right? Like we could have had a conversation 2 months ago, 3 months ago with someone in a variable, and it actually probably didn't make sense to convert because fixed rates were pretty similar to the variable at that time. And we've just seen bonds tank in the last month and a half. And with that significant drop in rate, this is where, to Tyler's point, it actually could make sense for someone as long as the term and everything else makes sense, right? So, back to understanding your product, some lenders, if you're 1 day into a 5-year variable, they will give you the option to convert into a 3-year, which is great. Other lenders, if you're 1 day into a 5-year, they will convert you into a 5-year fix, which is, we're not seeing a ton of that right now. I mean, it's all dependent on client situation, but that's something to be aware of too, before you make any decisions.
Before calling your bank and just locking in and taking whatever you're offered, like in Derek's situation, mentioning a 4-year fix, like you really, really need to look at a plan and have a proper plan in place and understand what is this going to look like for you going forward with whatever your future plans are, whether it's to upsize, move in general. Just understanding the restrictions of locking into that term is very important. So again, talking to an advisor and going through an actual plan is key. The last piece I just want to touch on, depending on the lender you're with, this is very uncommon, but there are lenders that are doing are actually charging you a penalty to lock in. So you're in a current variable rate mortgage, you're considering locking in, you're talking to the bank offers you let's say whatever, a 3-year term to lock in. Well, they're actually building in a penalty, a 3-month interest penalty just to lock in. Shockingly, and this is something we all talked about in the last couple of days here, that's pretty unheard of, like that lenders would do that. But there is a lender out there doing that. We're not going to name names, but there are lenders doing that today. They're actually charging a penalty just to lock in your variable rate mortgage. So if you're already going to incur a penalty just to lock in, like even more reason to consult and have a plan and just relook at everything you have going forward. So yeah, key point there is just definitely reach out, talk to an advisor, build a plan. So why don't we just dive into a bit of a case study here? This is an individual that a client that actually decided to lock in from their current variable into a 3-year fixed rate mortgage. So we'll just touch on this. The client currently had a prime minus 0.30% variable rate mortgage. So that would have been a net rate of 6.90%. So their rate today was 6.90%. It got to a point where like they just could not afford this house. This individual had to sell the home to just be able to survive. They were going in the hole by at least $500 a month, so they needed to adjust their monthly plan or payments by at least $500 a month. This client was able to actually source a 3-year 5.69% rate, saving more than 1% of interest. So pretty significant savings just by locking in. So just by going from variable to fixed, they were able to drop by over 1%. So to dive into like the actual numbers here, the mortgage amount was $680,000. Their original payment with the variable was $4,470 a month. The new payment with the fixed rate dropped their payment to $3,943 a month. So a difference of just over $527 a month. So pretty significant difference that achieved the $500, the dropping of $500 a month in their plan to actually be able to stay in the home. So they went from a position of, I have to sell this home, to a position of, oh, wow, I can actually keep the home and adjust my payments and have 3-year consistency of knowing exactly what my payments are going to be. So significant peace of mind for the client. And, just a bit of a caution here is it's good to know, it's really important to understand, like, what does that mean for 3 years? Does that mean, like, so yes, he's going to save significant money over the next 3 years. Could he save more if he stayed variable? There's a good chance of it, right? Like, there certainly is a good chance that the variable rate will come down more than the 1% or roughly 1.2% that he's saving. How long will it take for the variable rate to make that drop? So that's based on prime. That's based on the government deciding to actually make rate cuts this year and going forward. It is important to understand that pretty much every expert across the board, from a chief economist position with all the major banks and economists across the country, are predicting we will see rate drops this year from the government. Again, a lot of things could change. Wars change things, as we know. Things can reverse, as we know of what happened last year around February, March. But it's a pretty unprecedented amount of people are certainly predicting the likelihood of a drop coming this year is very high. But is it going to be a whole 1% or more? Hard to say. And how long it takes to get there is really going to what will adjust this equation. But in hindsight, like, we'll probably look back and the client will probably say, you know what, I probably could have saved more money if I stayed variable, but I just simply couldn't have stayed in the home.
If I'm speaking to that type of client, I'm like, even to the further segment I was talking about, like, what's your payment pain point right now? Just like if you speak to any realtor, like, they're going to tell you it's pretty much impossible to time the market. It's sort of like that with interest rates too. I mean, it's a total crystal ball prediction as to where interest rates are going to be, beyond the next 2 months, 3 months, right? We can kind of see where they'll be, 30 days out, maybe a little bit longer, but anything beyond that, like, it does become a bit of a guessing game. And, if we look at current market conditions and where we are with the economy, something that, if I certainly agree and believe that we probably do see some rate cuts. But one thing that kind of makes me a little bit nervous is, like, when everybody's on one side of the boat, everyone's predicting the same thing. Quite often the opposite can happen, especially in financial markets. And things can change quickly, like Dean mentioned. So to get back to the original point, like, what's your pain point with your mortgage payment? Because if locking in saves you $500 a month and you think, you know what, that's lifestyle changing for me, maybe pulling the trigger is the best thing for you, because what's probably going to happen is you're not going to look at your mortgage rate, and you're not going to look at mortgage rate news for a while because you're off the variable rate train, right? You're like, I'm out of here. I'm saving $500 a month. Whereas if that borrower's pain point's been like at an 8 or 9 or a 10 for, I don't know, a year now, they're probably pretty sick of looking at interest rate news and trying to figure out when the next cut's going to be. So I feel like lifestyle plays a good role, a pretty important role too. If it's going to make you sleep better at night, yeah, maybe you lose a little bit of interest payments down the road. But if it makes your life easier to live, for this client, it made a lot more sense than to try and hold off a little bit longer, keep borrowing from lines of credit or whatever to kind of get through this tough cycle. So yeah, that's sort of my point is, what's your pain point with your payment?
Yeah, and I mean, the spillover from someone that is struggling financially, like, you could be really hurting your credit too. Like, if your credit cards are maxed out, lines of credit are maxed out, maybe you're even slow on payments, like, to really hurt your credit. Maybe in reverse, if you did make that decision and convert and it kind of freed up some money for you, that's another big consideration. And only other piece I would add to all that is, like, timing is just the unknown in all of this. But, there are some people sitting in variable mortgages right now at 6.8%. Maybe they could convert, maybe they got 3 years left in their term, they could convert at 5.7. Pretty big decrease. You also have to consider, if you wait this out, and let's say rates start coming down in 4 months, is it going to be like a 1% drop this year, or is it going to be 0.25? Is it going to be half? Like, how long is it really going to take to get your 6.8 down to 5.8, which is just matching what you could potentially get today? So you got to kind of, and that's where it gets very convoluted. Like, what's that savings? How much are you going to save over the course of maybe it's 12 months before you actually reach the rate of today, right? Like, that's where there's just so many unknowns in all of this. But it like it could take 2 years to get rates back down by 2 full percent. It's just no one really knows.
I would just quickly jump in there. Like, that's a great point, Derek. And where you're not going to get that conversation from is, if you're considering locking in, is your bank, right? If you call your bank, you go to the branch and just say, hey, I want to lock in. We all need branch employees. We all need people to work at the bank, but they're not equipped to kind of dive deep into that kind of, analytical thought process of like, what's the numbers actually look like. They're basically an order taker. You ask them, oh, I want to lock in. They're going to give you the rate and that's it. There's going to be very little advice. Oftentimes these people are skilled in like 3 or 4, maybe 5 different things. They don't just focus on the mortgage piece. So I just say that, all that to mention, like, if you are considering this, like, the best person to talk to is a qualified mortgage broker. I mean, obviously we could all help you here at Thrive, but just don't expect that kind of good advice and deeper conversation from the bank.
It's another good reminder to whether these individuals at these institutions have the skill set or not. It is a business. The bank is a business. The institution that you're working with is a business, and they have to look out for the profitability of the business. And those people are trained to sell you on what's more profitable for them as an institution. And, to lock you into something longer term at a peak point in the market, touching on current market trends, we are at a peak point right now with fixed rates and just in rates in general. So for an institution to be able to lock you into something at a high rate for a long period of time is going to be very beneficial for that institution. There's no doubt. So just keeping that in mind, again, just not to hammer this too hard, but the advice piece is so crucial. The plan is so crucial. So we talked about pretty much, we've analyzed the market here throughout, what current trends are, where current trends are at, what we're seeing with current scenarios. Maybe just a few practical tips that we can just toss around, before we conclude here. Number one would be to really consider that plan. Again, I know I sound like a broken record here, but looking at everything, we talked about refinancing throughout this episode. Really, really understanding what you're paying on everything. It's I find clients get so fixated on their interest rate, their mortgage interest rate, especially at time of purchasing the home. They'll go to war to just get an extra 0.05% off their rate, but they won't consider, all the other assets that they have financing on, whether it's a car, a boat, just all these other things. Like, really, really looking at everything and understanding that, sometimes it's not just about the interest rate on your mortgage. It's about the whole plan. It's about the total amount of interest. So I think just really my number one tip would just be look at everything and build a proper financial plan around that.
Yeah, absolutely. I mean, we're going to get into a segment we want to start doing it called a little bit more, just like, ask the listener. And this was a question that came in to us this week for a client that was talking about locking in. The question was, okay, if we lock in, can we also consolidate some of our debt? And the answer to that is actually no, right? Locking in is just taking your current mortgage from variable to fixed. If you want to take care of current debt, which to Dean's point, you're going to analyze your full picture and whether or not a refinance makes sense. That's a whole new mortgage application, right? We got to requalify you to do that. But that's, if you're looking at doing that, looking at locking in, that might be the time to kind of assess everything and just say, okay, let's run some numbers, locking in versus refinancing. Can I save a little bit more by rolling in all this debt that we've accumulated, perhaps even after Christmas time?
Yeah, great point. My tip, I guess, would, like, you're listening to this, there's so many people that are in these situations, they just want to know what the options look like, and you are literally not going to know until you go through the process and talk to someone. Like, you might even have to do an application and send in some documents, which for most people will take you an hour total. The broker will have to do a bit of work on it, but like, to actually be able to open up that conversation, look at the numbers to see if it makes sense. Until you do that and reach out, like, there's no chance in hell you're going to be able to properly understand what your options look like. So I guess there's no harm in going through that process. There's no cost. It doesn't cost you any money. and it doesn't impact your credit. So if you are curious about this, you just got to reach out.
Yeah, totally. So why don't we conclude there? I mean, just to summarize a few key points, understanding when to lock in is always going to come down to a proper plan, having a conversation with an advisor, and again, building out the plan. We touched on just, when it makes sense to refinance, considering, again, dropping rates on all products, consolidating debts, re-amortizing, fixing cash flow. We had a great case study there where somebody was able to save a significant amount of money by just locking in. So again, looking at both aspects, it was a good episode in that sense. And again, I think the biggest piece to hammer home is just don't make any decisions without getting some advice. Touching on just a little bit of a teaser for next episode, we are going to be getting into some tax season prep for self-employed individuals. So looking forward to that one. And that's pretty much it for today. One piece that I did want to touch on, Tyler mentioned it, just some listener interaction, listener feedback. Like if you have questions for us, you want them answered on the show, throw them at us. We have a few that just naturally come in general. We're putting it out there. So I'm sure this will open the floodgates to a degree, and we'll certainly answer more than one going forward. And that's it for now. Looking forward to the next one.